this one we knew would probably be coming along sooner or later because there's some pretty big changes to Iowa's tax law. And we've noticed also with a few clients that people didn't really understand from the press coverage of it some of the changes that the legislature adopted. So I think this will be a really interesting and useful 20 minutes or so here today with Matt's presentation. So with that, I will turn it over to Matt. If you have any chat questions, I will try to monitor the chat during the time. And then with that, Matt, take it away.
All right, thank you. And thanks again for joining us. As Quinn said, we're looking at the recent tax law change in Iowa, but there's been several significant tax law changes in Iowa in the last few years. And so just so we're clear, we're looking at the new bill that was signed into law March 1st of 2022. And I just wanted to add that disclaimer because it's a little confusing right now. If you Google something along the lines of Iowa tax law, you might be reading info from the big, was it 2018 tax reform? And that tax reform had scheduled changes that were going to go into effect in 2023 and 2024. And instead, this new law that was passed, kind of overwrote a lot of that old law. So just wanted to say that going forward, that be a little bit careful, Googling and searching some of this stuff right now, because it's confusing and people are still updating some of their information online. But anyway, getting into the actual changes of this new tax law, what received the most headlines is the changes to the state's income tax rate. So this is the income tax brackets. Eventually, the state's going to move to a flat tax and do away with the current brackets, but it's a multi-year process to finally get there. Under this new Iowa law, the tax brackets are going to be changing in 2023, 2024, again in 2025, and then finally in 2026. And so what does this kind of phase in look like over the next couple of years? To start, here's the 2022 income tax brackets now for this year in Iowa. And it's worth noting that these brackets applied to both married and single filers. It's a little busy, 9 total brackets, rates ranging everywhere from 0.3% to 8.53%. And it was really that top tax bracket that got a lot of attention. That 8.5% rate left Iowa with the 9th highest state tax rate in the country. And then maybe worse, this high tax rate applied to a much lower income than most states. And so you can see that even a married couple with $78,000 in income was taxed at that high rate. And actually this led to a couple, with $78,000 in income in Iowa was taxed at a higher rate than a household with similar income in California or New York, some of those states that we think of as really high tax. It's just that those states have very high tax rates for hundreds of thousands of dollars in income. Iowa's really applied to much lower levels. And so that's what this bill was really made to address. And so the first round of changes are set to go into effect in 2023. Iowa will get different tax brackets finally for married and single filers, which is a big change for some. And in addition to that, you can see that the tax brackets are going to be much more simplified down to just 4 different tax brackets. And then even just next year, Iowans will be subject to a lower top tax rate. So just 6% is the highest rate instead of that 8.5% we have now. And for married households, you'll need a lot more income to get up to that top rate. So pretty much doubles up to $150,000 now. And it's worth noting before we go on that all these brackets that we're going to be looking at in the next few slides, the income levels are tied to inflation. So this is the 2023 income tax brackets, but before they go into effect, they will get an inflation adjustment that just with inflation might be pretty substantial. So it might not be that exact, $150,000 next year when this does finally go into effect. But what does this mean exactly? The numbers, of course, depend on income and any state deductions that you can get. But just for an example, a married household with $150,000 in taxable income in the state will save just about just under $3,000 in state taxes just next year, just from the change next year. And then let's see. So moving on now, looking 1 year ahead, we're looking at the 2024 tax brackets now, and you'll see that the top tax bracket from the prior year is just cut off. So no more 6% bracket. All that income is going to fit into the next bracket down, or the 5.7% in this case. And I should say these brackets that here and then the next couple slides are all for married filing jointly. Single brackets are just half of these income amounts. And so for a single filer, the 4.4% tax bracket is for income from $0 to $6,000, just for example. And then going ahead 1 more year to 2025, you'll see a pattern here. Once again, just that top tax bracket's getting cut off, and that income then goes into that next bucket down. And so the top tax rate will be 4.82%. And you'll notice these tax rates are pretty close. That lower one's pretty low income, effectively about a 4.8% flat tax for Iowa in 2025. And then 2026, the final year, scheduled changes go into effect. So we're just getting that flat tax now from 2026 on at that lower 3.9% rate. And so from 2026 on, whether you make $1 or $1 million, it's always going to have the same tax rate in Iowa. And so what do these changes look like for our example household? Remember that in 2022, this household would have had about $10,700 state tax bill on $150,000 in income. Now in 2026, that same income amount will see about a $5,850 tax bill, so close to cut in half. And so this seems like a pretty big change by itself for young working couples, particularly, just this by itself certainly is a big change. These tax brackets used to be just as big a deal for retirees too, since retirement account withdrawals like IRA and 401k distributions, and then pensions and annuity payments all used to be taxed at these same tax rates, these same tax brackets. But there's an even bigger change in this new bill that impacts retirees a lot more. And that bigger change is that beginning in 2023, there will be no state taxes levied on what the bill calls retirement income. And so what exactly is that? It's pretty broad in its definition. Any qualified retirement account withdrawal, so this is 401k, traditional IRA accounts, along with similar accounts like 403Bs and small business retirement plans like SEPs or solo or individual 401ks. In addition to that, any deferred compensation plan, what you might see is called a 457 plan, will be tax-free at the state level. Any pensions, this applies to government or private company pensions, annuities. And then I should say, just to be clear, Social Security benefits were already not taxed in Iowa. That's continuing. So this is not really a change from the law, but I just wanted to list it here so it's clear, and maybe not everyone knew that. Then the fine print for this law, in order to qualify for this 0% tax rate on retirement income, you need to be age 55 or older or be disabled. And so for most retirees that we see in Iowa, this is going to drastically reduce your state tax liability. And for a lot of people, it's going to leave them with no state tax due at all. And even with this new tax bill, what will still count as taxable income? And by that, I just mean what does get taxed at the rates and the tax brackets that we just looked at. Of course, wage income, so W-2 or 1099 contract work, et cetera. This will also include severance pay if that's part of your retirement plan. But then once you actually stop working, fully retire, what's left over? And so interest from your bank savings account, money market funds, I-bonds, interest from any bond investments that are in a taxable brokerage account will continue to be taxed by the state. Any dividends from stocks or stock funds that are in a taxable brokerage account, Likewise, any capital gains from investments that are sold in a taxable brokerage account. If you own rental property or have farmland that you get rental income from, that net income will still be taxable, even if you're over age 55. There's one caveat with farm rental income that we'll get to in a second. So just be aware. And then lastly, if you cash out or surrender any life insurance policy that is cash value, you will still pay state taxes on the earnings from that policy. And so this applies to things like whole life or universal life insurance policies. So still, a few things that may contribute to some amount of taxable income, but the big change here is excluding 401k and IRAs, along with pensions from state taxes. That's the big change here and has the biggest impact for most Iowans. And so we went through some of those significant changes to the tax law, but now, maybe more important, what are the planning opportunities now with this new law, with the change in the tax law that we had? One item that we've been working on with a lot of clients recently is Roth conversion plans. The whole idea behind a Roth conversion is just finding the trade-off between paying taxes now in order to avoid higher taxes in the future. And with this new law, we're in an interesting situation, especially this year, where we know future tax rates are going to be reduced and actually completely eliminated on the state level. And so that's changed the math up a little bit in some Roth conversion plans that we've done. Just for example, say you're looking at doing a $50,000 Roth conversion in 2022. Right now, that would result, right now in 2022, that would result in an additional about $4,200 in state taxes for a household that's already in the state's top income bracket. By delaying just a year, you can take advantage of that 0% tax rate on IRA distributions and pay no state tax at all. And so, it's more common that we're seeing a benefit to delay Roth conversions until future years just to take advantage of this 0% tax rate that starts next year. At the very least, we think it makes sense to hold off probably on really large Roth conversions, but that's not universal and really just kind of requires looking at your specific situation. In general, I'd say the older you are or the larger of an IRA or 401k balance that you have, the more it tips the scales in favoring still doing some Roth conversions this year. But again, by and large, there's a benefit in delaying just 1 year if you can. A couple other planning items we've noticed that are impacted by this law. First, municipal bond income. Because Iowa was a high tax state, very high income households with large taxable accounts, so not IRAs or Roth IRAs, but those taxable brokerage accounts, may have had some benefit in using Iowa municipal bonds in their portfolios. And so this was a little rare from our experience, but it did apply to some people and was very advantageous to those select few. And the benefit of Iowa municipal bonds is going to be greatly reduced from this bill just because the state tax rate is dropping so much. And so losing out on that kind of tax-free income just is not that big of a deal when tax rates get, more than cut in half. Let's see. And then for grandparents that are saving in 529s for their grandchildren, you're going to potentially lose out on that tax deduction if you have no taxable income now. Again, this is just because most retirees will have very little income if all they're getting is money from IRAs or pensions. There's just nothing to deduct from. Even for younger families, this is also a smaller issue. Just for example, in 2022, married household in Iowa's top tax bracket gets a tax deduction that's worth about $600 per child if they maximize 529 savings. By the time Iowa's flat tax rate finally goes into effect in 2026, the value of that deduction just gets knocked down to about $275. And so slightly smaller benefit. There is still a benefit there. This is not to say that 529s are a bad idea now. You still get the tax-free growth on any money you deposit, but there is a little bit less of an immediate benefit there for 529 contributions. And then lastly, we have two final slides here just to go over provisions in this new tax law that are really important, but apply for a smaller amount of people, maybe just a select group of people. We really just wanted to highlight these rules so that you know that if it applies to you, you should reach out to us for more detailed help. As a general disclaimer, just for the next two slides, these sections of the law get pretty detailed, pretty dense legal speak. There's a lot of fine print to these rules that would take, maybe another 20 minutes and many slides to go through. So don't take the text on these slides or what I say is the end all be all. Like I said, we're just trying to bring this to your attention so that you get an idea if some of these apply to you. The first benefit from this state tax law is that those who own stock in their employer. So if you participate in a ESOP plan, for example, this is for you, or if you do just own shares in your company, maybe you're a director or executive, or they've just offered that privilege. There's a new rule that allows the capital gains on those shares of your company to be taxed at a reduced rate and then eventually not taxed at all. This benefit's being phased in over the next few years. So for example, let's say you have $100,000 in capital gains from employer stock that you've held. If you sell in 2022, all of that 100,000 is taxable. If you wait until 2023, just 67,000 of those gains are taxable. And maybe worth noting, 2023 also has a significantly lower tax rate too, so you get that benefit also if you're able to delay just selling a year. But maybe just said another way, 33% of the gains in 2023 will be deductible. And in 2024, only 34,000 of those gains would be taxable. And then in 2025 and beyond, the sale of that stock would be completely tax-free. And so some basic requirements to qualify for this, like I said, there is some fine print. You need to have worked for the company for 10 years. That company must have a 10-year history of having a location in Iowa. The company has to have at least 5 shareholders, 2 of which must be unrelated. And so, really small family-owned businesses won't count for this. But you can see that if you own a very significant amount of stock in your employer, this is potentially, a really valuable benefit to know about. And then lastly, there's a special section in this new law to give farmers a potential tax break as well. And what they're trying to do here is just recognize that for those who were longtime farmers and own their farm now, eventually, if they rent that out, farm rental income is kind of their retirement plan, similar to a pension, or if they're going to sell the farmland, that should be treated similar to like an IRA. And so how they're doing this is now a farmer who owns their land and has materially participated in the farming of that land has a choice. They can either, one, elect that rental income from the farmland will be tax-free in the future, or 2, elect that the capital gains from the sale of that farmland will be tax-free when they decide to sell. And so again, a farmer gets one of these 2 options, not both. So you have some decisions to make on what option would be best for you. And that's just kind of personal. If you know that you want to pass farmland down to your family, taking the rental income deduction might be better. If you know you will sell the farmland in a few years, then waiting and getting the exclusion on the capital gains is probably a better route. And like all the other new rules we've talked about today, this does not go into effect until 2023. So even if this applies to you, there's nothing that changes this year. I guess I would think the only urgent item here would be that if you qualify for this tax break and are considering, maybe selling farmland right now, there could be a pretty big advantage to waiting just 6 months in order to get this tax break. And again, there's a lot to consider here to determine the best option for you and make sure you qualify, but just a few of the qualifying rules. Like with the IRA benefit, you need to be 55 or older or be disabled. You have to have materially participated in the farming business for at least 10 years and then now no longer be participating. So if you inherited farmland from your parents, for example, and get rental income from that, it's our understanding right now with how this is written that you would not qualify for that for rental income on that. You have to have participated in the farming of that land. And then going along with that, that just applies this tax-free status just applies to the actual individual owner of the farmland. And so if you receive farm rental income from a partnership or corporation or a trust or part of an estate, you don't qualify for this deduction. Again, not going to go through all the fine print here, but is just a little bit of a niche topic. And but if you know that this applies to you, this is potentially just a really important new part of the law. And so that's what we had prepared for today, kind of some of the big highlights of this bill. Hopefully you found it useful, helpful to know how it's going to change, what parts of this impact you. Again, we're happy to take any questions you have or follow up later. If there's no questions, happy Friday. Thanks again for joining us and have a great weekend.